What's going on, family? I got something special for y'all today. I put together this little slideshow about my introduction to ICT. If you follow me on Twitter, you know that I've been using these concepts for the greater part of just this year, and I found even more profitability in these concepts, or in my interpretation of these concepts. And I really want to put y'all on. So first and foremost, all this content is from my dude Michael J. Huddleston, Mr. ICT himself. So all praise where it's due. This work is his, and you can find the deeper dive into all his content. I'll have the link there. Uh, I feel like this is what I could have benefited from when I first got introduced to ICT by Rippy Mode. Shout out Rippy Mode. Um, when I first got introduced to ICT, I really could have used a quick guide or a quick handbook like this being explained to by somebody who knows how confusing it can be. So this is what I'm trying to give for y'all. Um, Again, this is not financial advice. Don't take it like that. This is just what I see. So it's time to change life, gentlemen. So the whole theory basically is based on that there's an algorithm that our strategy is based on big money, engineering liquidity. You'll start to see what I mean. So I'm just gonna link this slide so you can go back and look at this. I want to really dive into what that is. First and foremost, I would make sure that you know these terms when I say them. Time and kill zones. What those are is just at certain times we're looking for our setup to appear only at those times. Um, that's it. A fair value gap. Look at that as our support and our resistance levels. To somebody who's very, very new, just think of a fair value gap when you hear that. It's gonna be like a magnet price or a support or a resistance. And then liquidity. Liquidity is people in the market who have orders set or orders that are set in the market above a high or below a low. And you'll see what I mean. This is really powerful stuff, y'all. So first and foremost, the kill zones or when to trade. The New York AM session, you can really find a great setup between 8 a.m. and 11 a.m. If you really want to hone that in, I personally like from 9:30 to 11, 9:30 to 10:45. You can catch some beautiful moves. All right, so I would write that down. When you trade is equally, if not more important than the price action. Time comes before price. So even if price does exactly what you want it to do, if it does not occur at the right time, it is a low probability trade or a lower probability trade than if it was on in line with the time. So just you need to know that, right? The next session is the PM session, which is 1:30 p.m. to 4. That's the New York PM session. I really like power hour, the last hour of the day, 3. Start to look for something around 250. Maybe price delivers to what we want to see at like 310, 315. That's it. So as you can see, it's really refined on when we're even allowed to trade. Without even knowing what the rest of the system is, you can see how this puts boundaries and it puts rails on you. So you're safe. So you have a system. All of this is going to come together. So a fair value gap. You've probably heard about this on Twitter or seen people talk about what a fair value gap is. It's just a 3 candle sequence. So this is a bullish one right here. Candle number 1, candle number 2, which is typically a displacement candle. It's going to have a large body. And then candle number 3. You take the high of the first candle, the low of the third candle. If there is a gap where they don't intersect, that is a fair value gap. That would be referred to as an inefficiency. I'll put it on you real quick for those who care. Basically, what this is saying is that the market moved so fast or so powerful through this area, there wasn't fair value given to buyers and sellers. Buyers and sellers in here did not get an opportunity to participate in the market because price just moved so fast. So what that means is this is eventually going to be revisited. Okay? I'm going to say that again. It's basically people who got left behind on the big move. And the market, this is a fair market overall, buyers and sellers. So everybody who's in here who has their orders, it needs to come and they need to get filled. You honestly don't even need to know that though. Just understand that this is a bullish fair value gap. When this is left, you're going to look for price to be attracted into it. On the other side, you got the bearish fair value gap. It's the low of the first candle, the high of the third candle, and it's going to make a gap. All right. It's very simple. Here's an example of some trades that I took using this. This is a bearish fair value gap down here on the left. So I want to point your attention to this first gray candle, this second big black candle, which is red, and then the third candle. As you can see, there's a gap from here to here, which is highlighted by this blue box. Just pay attention to the blue box. As you can see, price then, we wait, price is attracted into this box, and then we use it as resistance. And we enter, as you can see, we entered right here when price showed a willingness to push away, and we target lows. All right. That is a fair value gap. That's a fair value gap trade. This is everything right here. Check this out. Same thing. We have one candle, the second candle, and then the third candle. Blue box from the high of the first, low of the third, draw it out, enter at 50% of the fair value gap, which is like the best entry you can get. I love when they come down into 50% and the bodies of the candle respects it. And then we see price target a high. I really hope y'all are able to follow along because I'm about to get passionate about this because it's like right here. The market, this shit is telling us a story, y'all. Look at this right here on this bottom left. This is the story that this market is telling us. We're in a downtrend, right? The market's moving down. We leave equal lows. I personally would have thought that's a double bottom back at the start of my trading career. The market did this on purpose here and here. They left that as a double bottom. Why? I'll tell you. Because people see this, they think double bottom. They think that now we can go long. Now we can go into calls because we think the market's going to go up because this is support. But it's not support. Support and resistance is not why the market is moving, is the concept that we trade. The reason they left this double bottom is to have so many people go long here, and their stop loss is going to be right below this low because this is support. Price isn't supposed to go below here, right? So what does it do? It attacks those people. They're right for some time, but they're probably targeting these highs. The market's not going to let you get up there. The market planned all of this. This move was all pre-planned. Why else would it leave the fair value gap? It left the fair value gap simply so price could retest it, and then we could go take out sell side liquidity. It just makes too much sense. Okay? Crazy powerful stuff. Liquidity. This is orders sitting above old highs, below old lows. Basically, like orders in the market. And what we trade is the market is going to target these areas, these highs or these lows, as the move. So I made this for you guys. Check this out. This is like a consolidation range. Traders see this as resistance because we got like a double top here, and they'll be shorting the market or thinking it's going to go down with a stop loss above here. And then on the downside here, traders see this as support because price comes down and is touching it. They see this as support, and they're going to go long with the stop loss below this low, right? This is what's really happening. What would really happen? Say that the move is going to be a move to the downside. They're going to give you a good move to the upside. They're going to take out all those people who are shorting right here because this is resistance. The market is going to go trigger their stop loss by coming up here and then reversing, using their stop loss as fuel for this move down. And then this move down is then going to target this area of liquidity, which is below this low. All right. I hope this makes sense to you guys. Again, purging up here, if you'll hear that term, or the market is just going up here to fuel the move to the downside. Write this down. We sell high and we buy low. It's that simple, right? If we break these lows and we take this sell side liquidity before we took this buy side, I'm thinking to go up. It's going to go up. But the low just broke. I'm getting in my trade right as the low breaks. It's counter against everything I was ever taught. I was taught to, when a low breaks or a high breaks, that we're going to get continuation. That's They tell us that simply so we get caught up. This is exactly what I'm talking about here. We're in a range. Take out one side, people think that, look at this crazy candle. Everybody's thinking it's going to go down, and then it just reverses, and it's going to target buy side liquidity. Here's how it could look in the market. This is just a super clean look. It doesn't have to be a lot. It doesn't have to go and take out the low by a lot. So check this out. The market is just consolidating, 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 and then eventually it breaks the low, the defined low of the range, and then it goes. And then it goes. So it's just the market is designed to hurt you, right? Moving on, we got a market structure shift. That's a big, what that is previous price patterns that we are respecting. So if we're in an uptrend and we're making higher lows, a market structure shift would be when we violate one of those higher lows and we start making lower lows. You see that right here? Higher low, higher low, higher low, higher low, come up, and then now this low on the right is lower than this low. So it's a change in how the market's moving. It's a market structure shift. Put simply, it's when price violates the current trend. So the current trend is up. Now you can make a case that the current trend is not, well, it's not up anymore because it broke the trend. This is a bullish market structure shift, y'all. Right here. We're going down. So the market structure is bearish because we're going down. The second we break this high, that's a higher high. If we break this, the second we break that, that's a market structure shift. So now we know that the trend could now reverse and be bullish. We're bearish until one of these highs are broken. Okay? Looks just like this. Bullish uptrend. Here's the highest low. It gets broken. This would be the market structure shift. Now, it's all about to come together on how we can use all of these tools to make some bread. Check this out. This is the setup that I use. We wait for liquidity, a high or a low, on a higher time frame to be taken. Once the liquidity gets taken, so if we sweep a high or we sweep a low, I wait for a market structure shift. Higher. Once the market structure shifts, I will wait for it to leave a fair value gap behind. So if it's a bullish market structure shift, I'm looking for a bullish fair value gap. If it's a bearish, I'm looking for a bearish fair value gap. I wait for price to move into the fair value gap, retrace into it, and then target some lows or some highs. It would look exactly like this to the downside. This is called the 2022 model. If you're interested, the ICT 2022 model. It's really all you need, especially for beginners. So as you can see, market's moving up. Imagine that there's a previous high back here. Previous high. We go and we take that liquidity. We take that high. Now, this is our low. That low gets taken out by a big candle. That big candle leaves behind a fair value gap, which is highlighted. and then price trades pretty damn close to 50% of that, and we're targeting the low. That is the setup. That's it. Lastly, folks, I just want to say thank you. It's been a crazy year for me. Ever since I really started sharing my journey in depth, I've been getting a good response from people, so I really appreciate y'all to the fullest extent. Uh, the last thing I'm gonna say is, please use social media as your resource. Use the internet as your resource. There's an unlimited supply of information. So shout out to Rippy Mode, Keyflow Trades. Those two traders, I took some things from their book and made it my own, and now we're here, right? So I encourage y'all to do the same. Expose yourself to a whole bunch of different stuff and then figure out what fits your personality the best. So I hope this video was helpful for y'all for real. Stay smooth, all right?